Welcome to PM Express Business Edition. Government has extended what it is calling the revised domestic debt exchange program again. It is now hoping to close the chapter on this initiative on February 7, 2022. The Finance Ministry is expected or should have come out with their revised memorandum of understanding for the various stakeholders today. But could the bondholders have gotten a better deal with respect to what the ministry has presented? And what will be the impact on the broader economy? Well, on PM Express Business Edition, we'll be looking at the revised debt exchange program and its impact on the broader economy and what is on the table in terms of the deal. Well, my guest for tonight's program will be Professor Lord Mensah. He is a finance lecturer at the University of Ghana Business School and also a consultant as well. Kingsley Kwesi Kobson, he is a chief executive of the Ghana Insurance Association. He will also be joining us. Professor William Wabating is head of the accounts department at the University of Ghana, Lagos, and also Dr. Daniel Sedo. He is a former chief executive of the National Pensions Regulatory Authority and also a consultant as well. So it's PM Express is a revised, that is what government has presented in terms of the domestic debt exchange program and the broader impact on the larger economy and also what is on the table in terms of the bondholders. We'll be right back after this break. Welcome to PM Express Business Edition as we look at the revised domestic debt exchange program that the Finance Ministry has presented and also the broader impact of this on the economy. And for the bondholders, could they have gotten a better deal than what government has put on the table? Well, we're looking at this with the finance lecturer at the University of Ghana Business School, Professor Lord Mensah. He is with me in the studio here, and I appreciate his time so much. Quite a challenging period for him, but he has still made his time to appreciate it so much. Also, we'll be talking to the head of the accounts department at the University of Ghana, that is Professor William Boateng, and also Dr. Sedo. He is a consultant and a former chief executive of the National Pensions Regulatory Authority as well, and the chief executive of the Ghana Insurance Association. As we look at the revised domestic debt exchange program, what this will mean for the bondholders and also the bigger and the larger economy as well. But before we get into details, let's just roll on the screen. I mean, in terms of a breakdown of what the ministry has presented to these bondholders, in terms of the breakdown, the debt numbers, the composition, and what actually it will mean for you and I out there. So before we get those details, how are you doing? I know it's
very well.
time.
Very well. I mean,
school has opened.
Oh yes,
getting all those things done. Yes. And the domestic debt exchange program, they don't make you sleep.
I tell you.
It's interesting, right?
Yes. I mean,
so
the dynamics is quite new to the investor community.
Yeah.
I mean, it's a lesson for all of us.
Do you think that we are rushing this thing?
We seem to be rushing. Because if you look at the numbers that were churned out and the time that we are using to negotiate, we did not give the investor community to absorb the kind of information that is before them for them to think through as to whether they can, adapt or adjust to a level where they can come to a compromise. We just seem to be pushing things down the throat of the investor community, which I'm afraid of the post-debt exchange, what is likely to happen. Because we need the same space to rebuild the economy. So basically, that is my worry now as we speak.
And we'll be looking at the bigger picture in terms of what this means for the economy as well. But let's just roll the numbers for you just to refresh our viewers in terms of this domestic debt exchange program that the Finance Ministry has presented in terms of the revised document. And if you can see that there's you're saying that the deadline or the new deadline is February 7, 2023. Individuals are free not to participate. However, the old bond may have limited tradability. Interesting thing
there. They have liquidity problems.
Yeah, final discussions ongoing with organized labor and pensions fund trustees as well. And that bit is also interesting. It's caused another whole round of issuance of statements from organized labor as well. Very interesting, some would say. Well, in terms of the new terms for individual bondholders, if you are above 59 years, below 15 for 9 years, you're going to get 10% coupon. Now, the new maturity date is 5 years. Retirees are going to get 15 as well. Now, first deadline in terms of this, you're looking at somewhere around, in terms of the revision, it started from December 19 to December 30, January 16, and now January 31, and also February 7 as well. Interesting. So the composition of the debts, I mean, some will say pension fund status, yes, of course, insurance association, of course. Initially, that is exempted. And then it looks like these are the groups that are part of the whole thing as well. And also the DDA expectations, the item initial debt to be restructured. We're looking at 130, and this is the part for me is very interesting, Prof. We're looking at 137.3 billion. Yes. Now, with respect to the revised, excluding pensions or pensioners, 132. Interesting. Government is targeting 80%. So, and Prof, another critical thing I also want to ask myself that whilst we are pushing for a pound of flesh, have we thought about the ability of government to pay as well?
Yeah, that's very, very key. That is where, I mean, they've given the red flag that if you're holding an old bond, then you may have a problem with tradability. It's unfortunate in our environment, it's only government that has been issued bonds all through. And if you look at the structures, the thinking has always been that government bonds are risk-free. And the definition of risk-free has always been like, okay, the likelihood of default. Forgetting that if you hold a bond and interest rate changes, you are likely to be exposed. So effectively, our understanding of what we call risk has always been a problem. And so the ability for the government to pay depends on how they manage the fiscal space that they're going to have post the DDE. So we all understand that this is an exercise that will bring about some kind of, interest savings. And with this interest savings, how is the government going to use this interest savings? So my, look at the entire frame of DDE is pre-DDE, which has to do with the signals that you send out there, and then the DDE itself as we are going through the restructuring, and then the post-DDE, what is likely to happen. So effectively, you need the investor confidence, one. And that is why the initial structure that was proposed, 0%, 5%. I mean, we've never had interest rate structures going to 0%, 5% in our environment before.
We understand Lazard, the international
restructuring. I'm not surprised because I've said it on another platform that, look, this might be a consultancy outsourced from someone outside. Because if you understand our terrain very well, you will never propose that interest rate for any investor in this country. So effectively, the space, so let's assume that government is not paying interest of about 80% of the 132 that is being proposed. That 80% becomes more or less an inflow to the government. Now, this inflow, what is government going to do with it?
Interesting.
Very, very important. If government goes all out to spend the way we've been doing without looking at efficiency in spending, then there's going to be a problem. Because if you look at the happenings in the past, especially we're going into election year, 2024.
That has always been our bane.
Exactly. So that
cycle in terms of economic prudence and all
that also brings about the questioning of the timing of the debt restructuring. Very, very important, the timing. So
and then IMF program as well.
Exactly. Should we have done it later after elections so that, we go through the elections with kind of pain without necessarily having money available to spend as we're going to have now? Because once we go through this debt exchange, like I said, interest rate payment is going to reduce on the balance sheet of what?
Government.
The state.
Some savings there.
Now, some savings in there. IMF is also going to engage us with a program. So if it's a 3-year facility, then we're looking at every year probably 1 billion coming in. So on top of what government is saving as interest payment, coupled with what? Taxes that government is going to raise through the structures that we have. Obviously, will make money available to the government. And you ask yourself, how is this money going to use judiciously?
Prof, I want you to hold on there. I want to quickly bring in Dr. Daniel Sedo. He's the former chief executive of the National Pensions Regulatory Authority, and now he's into private consulting as well. Doc, thank you so much for your time, for joining us on PM Express Business Edition. And for you, one thing I want to put to you is that could we have gotten a better deal than what has been put on the table for all the bondholders out there?
Thank you very much for the opportunity. Better deal for who? The bondholders. The bondholders should rather be in a position of strength. So if we are going to get things right, then we should be consulting them a lot more. I believe the bondholders are doing government a favor, not government doing the bondholders a favor. Governance, for me, is to serve people. And if you're going to serve them and you're doing things that is hurting them and they are complaining, you need to listen a lot more. The bondholders have also planned their lives. And so they demand that respect to live according to their plan. If there are disturbances, yes, consulting them to make their contribution is better than imposing things on them.
But Doc, I asked my guests in studio here one critical question, and I know some will look at the budget and say that, George, what are you talking about? But the concern here is that the ability to pay as well on the part of government. Should we be worried as a bondholder?
We should be careful raising that argument. Except you're saying we've stopped paying taxes. Except you're saying we've stopped generating economic activity. Look, one of the issues or the argument we've heard from those in government is tax to GDP. And they interpret it as we not paying enough taxes. I do not believe in that school of thought. The real issue for people like me is the quality of the GDP we produce. Now, the GDP must generate for you what we call the chargeable income. That is the profit before tax. But if we are highly inefficient and we can't generate profit before tax, we'll run into the kind of trouble we are seeing. And most of the entities that are not able to generate profit before tax are the state-owned enterprises. So if what government owns cannot be used to generate profit, and then you now come back and turn on those who can work to generate profit, you are creating a problem that will be difficult to solve. What am I saying? If you look at us, the way we've configured ourselves, is the financial services, the telcos, even that one, and then probably the oil and gas. That's where the profitability is coming from. So when you descend on those sectors, you're setting up yourself for failure. And we need to pay attention to these things.
Doc, I mean, you have operated in the insurance space. You've operated in the pension space. Are you worried about the medium or short to medium future of these spaces as a result of this domestic debt exchange program?
Yes, I have been fortunate to operate in a lot of the financial services sector. I've been fortunate by my training. Now, we're talking about debt sustainability without discussing the capacity of these institutions to continue in business. Now, if we take away their capacity, which is what we are doing, their ability to go forward and being profitable reduces. Now, when you are not being profitable, the tax you are looking for going into the future, you will not get. Now, for instance, if you pick the banks bought bonds. The question we should be asking, did they use their equity to buy those bonds? Or is depositors' money, the float they've created, out of that float, that's what they've used to buy those bonds? And for that matter, the depositors will soon be coming for their money. So if you've weakened them, once the depositors lose trust and they start marching towards the bank, you see that everything will start collapsing. Now, when you run an economy that is difficult and you grant loans to people, you're going to see the default rate also going up. Now, if you take, let's say, the insurance companies, look, we all know in this country, the insurance companies work hard, but the profitability doesn't come. The profitability comes through investment income. And it's their investment principle. That is what we have seized. So do you expect them to assume risk and pay claims? There will be a struggle in paying claims. And once that happens, people lose confidence. And trying to build that critical mass from insurance for us to mobilize resources, that also becomes a problem. And if you go to pension, when you have pension is supposed to be long-term, we all know. And that's why we created the pension industry. But unfortunately for us, they've also become victims of the mistakes we make. That is, mobilize this time long-term resources, over 80%, and then give it to government to do recurrent expenditure. We can't build our future. So we seriously, we need a rethink of what we are trying to do.
Doc, I get from you that claims could be a big challenge for the insurance industry going forward, and also revenue as well, a major hurdle for government, because some are saying that with the way things are going, revenue will be impacted, but government is hoping to actually spend more this year.
Yes, revenue will be impacted. But look, we should be engaging the people who generate the revenue for us. If you take GRA has done fantastic in recent times. We need to congratulate them. But they need to take it a step further. Now, if you take a business that is not paying the desired tax, my view is that get closer to them, trying to understand what their difficulty is. I do not believe everybody is out there not to pay tax. I believe in paying the due taxes. But work with them. Eliminate the bottleneck. Set them up to be profitable and encourage them to pay the right taxes. I believe they would do that. There are real challenges in the economy. My personal view is if you look at our economy critically, the inefficiencies that we have that create problems for most people, and the reason why they are not profitable comes through government activities. And they will stop and try to look at that and have a mindset of government first giving to industry. Government first giving to industry. So the industry can respond and reciprocate. We will still have challenges going forward. If we want businesses to pay tax, throw something at them. Encourage them to do well. Our first responsibility is to get people employed so the household can live a decent life. Even if you don't take PAYE, if they are paid, there is the consumption tax. What they consume, they will pay. So let's set up to create businesses that can be run profitably. We know the challenges with the SOE, so we must appreciate the challenges with other private businesses. At least we listened to the poultry farmers this morning, the challenges they are going through. What is it that we are doing to support them? Nothing. So who will be working to generate the tax for you? We need to pay attention to them first. It's not about taking people's capital. I do not think that we are really addressing the issue concerning us.
Dr. Sedo is former chief executive of the National Pensions Regulatory Authority and a consultant as well. I mean, Doc, as I let you go, your final thoughts for you. Some will say that, do you see the light at the end of the tunnel, or it's quite bleak for you?
No, but my contribution would be, let's think deeper than what we are doing. And now, if you follow the process so far, when people push back, then we go and do some thinking and improve it. There's a lot more fine-tuning we can do. We need a fine balance. I do not think we have achieved the balance yet. I will speak about one of the regulatory forbearance where they introduce what they are describing as regulatory assets. I mean, and I'm asking myself, regulatory asset representing what? If it's a loss, it's a loss. And how do you write off that regulatory asset? I'm being told they've given you some number of years to write off regulatory asset. Against what? You must make profit before you even think of writing off an asset. When the environment is tight and we can't generate the profit, there's nothing to write it off. And we should not do things to be deceiving ourselves. We should confront our issues. The fundamental issue for me, let's mobilize people to be productive and be profitable and be competitive. Productive, profitable, competitive. If we can get it right, we can solve our problem.
Dr. Daniel Sello, thank you so much for your continued. I mean, let me come back to Professor Lord Mensah. I mean, it appears that, and I asked you that question earlier on, that we are rushing this whole process. I mean, as far back as 2021, we knew that we have to do a debt restructuring program. We kept everything under wraps. Lazard was brought in doing their preliminary work, or even 2020, if I'm right.
Oh, yeah. I mean, if you...
And now we appear to be rushing the process. This is things that will impact on people's lives for years.
I understand. So whilst we are looking at the economic dynamics of the entire exercise, we should also look at the political dynamics as well. We cannot, separate the two.
Yeah.
Obviously, a particular administration knows that we're supposed to work within certain time frame. And we're going into next year. It's purely campaign year. And so how can we structure the economy in such a way that we make funds available to spend? That is basically the entire exercise is about. We appreciate, the fiscal space that needs to be created, but then the timing. And then also we need to understand that debt restructuring, it doesn't matter how you look at it. You're going to distort the financial space that you have.
That's a fact,
no
matter how it's done.
Exactly. We've already had a shake-up in the financial space.
Confidence was just building up.
The banking sector cleanup, which we're building up gradually. And suddenly, this also came in. So if you're going to, shake an economy in a double form, should I borrow the vice president, double whammy, that kind of, you have to be really careful. Make sure that the analysis and then some of the possible shock absorbers that the various institutions that are going to be affected, can receive are clearly done. So you can't just take overnight and then get up and say, we are,
zero coupon.
Exactly. It's quite problematic. And then also, the information you put out there. So can you imagine government saying that we're going to engage banks, we're going to engage the various stakeholders of the bonds, and in the end, information tickles down that, look, if you don't go and take your money, government is coming to do restructuring. You'll be in trouble. You will cause serious bank run. You will end up getting more people disinvested. And at the end of the day, you will not have any, financial space anymore to run your economy. So effectively, you have to be tactical. And the timing of the information when you put it out. So I think government managed that aspect where they came out to say that we're coming to do debt restructuring. At the end of the day,
no haircut, yes haircut. I don't know whether it's about trying to manage information.
But
some will say that
that's
communication on this has been terrible.
Yes, it has.
First, no haircut this.
You see, the way
it even started, where some communication leaked. It's.
I understand your frustration, but then I started by telling you about how we define risk. The same way, the definition of haircut was a problem, because.
No, but some will say within government, they all knew. A little finance one, my lecturer told me a Legon.
Exactly. But we need to understand that the president himself came out to say there won't be haircut.
Who briefed the president?
Yeah, but he's saying that there won't be haircut.
Based on what he's been briefed.
Talking about your principal. The principal will not be cut. That's what, the understanding of haircut means.
But in such a delicate thing, he shouldn't have been coming out to say all these things.
Hold on. So president has been briefed. President, Mr. President, this is what we are coming to put in place. Bondholders are going to still have their principal intact. Means that there will be no haircut on your principal. But if you look at investment and you define investment very well, whichever way you look at it, whether you prolong the debt maturity, whether you reduce the interest rate in the manner that we've had earlier, it's still a haircut because the investor's expectation will definitely be changed. So if I'm expecting 20%, and you in the current state of form of the debt exchange that we have for individuals, I'm expecting 20%, and you reduce it to 10%. You've changed my expectation. It's a haircut. My bond is supposed to mature within 2 years. Now you're extending it to what? 5 years. It's still a haircut. Because within 2 years, if I were to get my money, I could have had alternative use of it. So effectively, but the principal is intact. So you can tell me that there's no haircut on the principal, but my interest in the extension of maturity is a form of haircut.
In a market where they are not that sophisticated, obviously, when you are coming out to communicate on this subject, you have to be very tactical, well coordinated.
Yes, you're right.
Information here, not this, it will be done, and this. Everything was done.
So chaotic. I mean, so chaotic. And information is the hottest commodity on the financial market.
Yeah.
The first thing you must touch is information. If you don't get it right, that's why I'm worried with the post, debt exchange. Because the same investors that you are dumping their confidence, you will need the same investors. Yeah. So if investor says that for the way you've managed my money, if I have another option, I'm going to put my money there. How would you mobilize funds to run the economy? So effectively, we have to look at a post, DD, and information management is key to have a good post, debt exchange.
Let's look at the revised document that government has presented.
Sure.
Today, they should have done a revised memorandum, and I stand to be corrected if the Ministry of Finance has come out with that revised memorandum of understanding that all the commercial banks are waiting and all those things.
Right.
I mean, if you are advising a client right now who's before you has about 300,000 or 400,000 locked up in these various papers, what would be your advice? Is this revised offer good one, or you might have to take it like that?
Right. That's a very good question to ask. So we may have to take so many things into consideration. We may have to look at how many years left for me to have my bond mature. So maybe it's left with 2 years. I'm going to receive 2 coupons within the 2 years. So probably we're looking at 20% 2023, 20% 2024. Now you have extended the bond. Now you said you are going to give me maybe 10% for 5 years. Cumulatively, my interest on principal is about 50%, which for the 2 years I would have earned 40%. So I'm more or less enjoying a premium of, let's say, 10% to extend the bond to 5 years. So it depends on the investor, the time to maturity of the kind of investment the person is holding, and then also the investor's behavior, whether he's ready to take on the coupons that is coming up now, because some investors invested purposely for the coupons.
Yeah.
Others invested because they want their capital to appreciate. And I know for individual bondholders, most of them are pensioners. Most of them, because immediately they receive their lump sum, that's where they go. Because the essence of the lump sum is to have a kind of package or fund that you can control yourself, whilst your pension's regular income monthly also comes in. So effectively, most of them direct the funds to government bonds, and they invest long term. So they lock it for about 5 years, lock it for about 3 years, and then the coupons comes in, and then they use it to satisfy their recurrent obligations that they have with their families. So effectively, it depends on the investor, and I can say that with the pensions, those who are 59 above, as stated in the new, DDE, clearly their package is not bad, because I know most of them are expecting around between 18 and then 20%.
So I get from you that it's more of have a loaf is better than none, right?
Oh yes, government is giving them more or
it.
less 15%, which seems
so they should
okay
accept
for
it.
now. Yes, for now that
Interesting.
That looks good in a way. Yes.
So if I'm a bondholder, should I go ahead and sign?
That is for 59 above.
What about 59 and below?
The 59 and below is quite dicey. For me, that one, a lot of analysis needs to come in. And for them, maybe if you're expecting 20% and they're doing 10% for you, that's far below expectations.
I'll be going back to get to Dr. Sedo's thoughts on he is somebody who's above 59.
That's far below expectations.
and see whether he's going to sign up or not. So we're getting back to get to Dr. Sedo very soon. So you're making a point here.
So effectively, the 59 below, I think that is quite lower, far below expectations. And I believe that maybe it can be relooked at.
I mean,
but let's also look at it. It all depends on government's target. We're all sitting here having a revised target of 132 billion, possibly reducing it and getting 80% of that. Now, 80% of that, if government should, go by all these restructuring, putting up this interest rate closer to the expectations of the investor, would they be able to meet up the target? Those are the things, analysis that must go on to determine.
Do you think that
rate.
this offer should have come way earlier?
That should have been the starting point. But then probably the government was also being strategic. Come hard and get what you want. So they came hard, 0%. The investors' mindset will be that, after I was about to lose everything. So now, if you are giving me 10%, let me more or less, buy it.
As we switch, when you engage some, depending on who you are engaging, you get that doomsday because of this program. Now, engaging the governor of the Bank of Ghana, he gave some scenarios that, listen, there is pressure on the reserves. If these debt freeze is working, if this debt restructuring is going to work, that is going to lessen the pressure on our reserves.
Sure.
It will have impact on the currency and all the rest. The IMF managing director was in Kigali, and she was asked a question on Ghana's debt exchange program. Sure. And let me try and, before bring in Dr. Daniel Sedo, and I'll quickly come back to Doc, if you were there, what I was just trying to find out from you is that with the... So you're going to get him back because you're going to get Dr. Sedo back on the line because the line dropped there. You're going to get him back quickly. But I'm saying that depending on who you engage, the IMF MD in Kigali recently said that she is expecting Ghana to get back, and I found that comment very interesting.
The international market.
As soon as we close this domestic debt exchange program. Depending on who you are engaging, it doesn't really appear to be that doomsday. Per your analysis and all the rest, the savings on our reserves, interest payments, we are getting some understanding that there could be the likelihood of the numbers being reviewed again, possibly in the mid-year budget.
Sure.
And that will also show government's commitment to do that fiscal cuts and all the rest.
Sure.
Really, is this thing that bad for the economy?
Oh, yeah. If you look at the happenings now, it all boils down to government and their, appetite for spending after the domestic debt exchange. If government continue the momentum that they have in their spending, trust me, this exercise that we're doing will be nothing to write about. So we hope that government will give that signal. And as you mentioned, in the media budget...
Would you want them to use a media budget to show this commitment of the cuts in
that is
expenditure?
very, very important. And in fact, if I'm to look beyond, the engagement that various, financial institutions have had with the government, what was missing, was the post-DDE, how government can be committed to some of the things they say. Fiscal discipline. And probably most of them were relying on the presence of IMF, at the time. Because we know when we go to IMF will give us that kind of restrictions on how we spend. And now they're going...
prior actions, they're asking for certain critical things to be done.
0% financing from the Bank of Ghana.
Publishing of the COVID-related
earlier the last IMF we went to was 5%. We couldn't manage the 5% well. It took us very short time to go back to IMF. So now it's going to be harsh. So you're going to do 0% financing.
I'll come back to you on, and it's still the doom. So for you, you don't think that it is really that bad?
It all depends on how government manages its finances. And as I mentioned, if government continue to spend the way we've been spending, recklessly, inefficient spending, we'll end up coming back to the same situation.
Doc, Daniel Sedo, I know you're a bondholder. Maybe you don't want to talk about that. But with this revised offer that has been put on the table, is this something that you will consider it?
Serious challenges. The same government that is giving us the impression that they have challenges to pay the existing bond is issuing treasury bills 30 plus. So that tells you we are not allowed.
Are you worried about that as well? Because some people have said that, listen, we should watch that space so much. Over 30% interest on treasury bills.
So I'm just pointing you to the inconsistency. And inflation is about 54 plus.
Yeah, you're right on that one.
And so if Prof. Mensah is saying people should accept, the 60 plus should accept, the 60 plus will be highly disadvantaged when inflation is so high and when government is issuing treasury bills at 30 plus. That doesn't exhibit fairness and consistency. That is why people like me would always say, let's go back and rethink this thing and do it properly.
But now, Prof, Doc, sorry to cut in here. I'm sorry. And I know that it has to be done right and no compromise on that one. But some are saying that we are also racing against time.
Time to do what?
To get a fund program, to get an IMF program, that this economy that is on life support.
No. Then let me share my theory with you. That assuming we try, what are we expecting from IMF? 3 billion over 3 years. Now, let's say we put that 3 billion up front and ask Ghanaians, 10 million of us, to raise the 3 billion. Each person will give us $300 in a year. Even you, George, sitting in the studio, when we push you, you'll give us 1,000. But the question you will raise would be that, would the money be put to judicious use? So what we are saying is, when we engage properly, we should be able to raise money to do a lot more of the things. If we see efficiency, if we see judicious use of the money. The way we've structured it, with the tax complications, which we are not discussing, the aftermath is not what we are thinking of. It will be difficult for all of us to manage. We must still have institutions with capacity to be productive and to generate the taxable revenue. We shouldn't do this thing and leave those institutions very weak positions and unable to generate the taxable revenue. So, yes, we are racing against time. But to do what? To do the wrong thing?
With respect to the time left, I mean, and Doc, do you think that anything can be done?
A lot more can be done. When this whole thing started, we're made to understand that we have limited time. But when there was a pushback, the position started changing. Like Prof said, if we had engaged properly initially, by now we would have got a fine balance. And everybody will be okay. There's a need for everybody to contribute, yes. But you don't contribute and kill yourself at the end of the day. But you must contribute and still continue in business. That is my position. Contribute and continue to be in business. And a lot of the things government is doing, the project, have we thought of saying that, look, let's develop a proper capital market and get a capital market people to assume responsibility for those projects? Because people will not stop contributing pensions. People are still working. People will still contribute. Where will those contributions be going? Would it go to government and to be used on recurrent expenditure? If yes, we are not solving the problem. So for me, there should be a holistic look at this whole thing we are trying to do and do it properly once and for all.
Doc, don't go. We'll take a short break. When we come back again, I'll be looking at for you going forward again, how can we hold government to some of these strict expenditure and all those things, fiscal discipline and all those. This is PM Express Business Edition as we look at the revised domestic debt exchange program and its impact on the broader economy and also whether the bondholders could have gotten a better deal. We'll be right back after this break. Welcome back to PM Express Business Edition. It's the revised domestic debt exchange program and how this will affect the larger economy going forward. And also for some who say that, could those bondholders have gotten a better deal? Dr. Daniel Sedo is the former Chief Executive of the National Pensions Regulatory Authority. He's also a consultant. And also in studio here, Professor Lord Mensah. He's a finance lecturer at the University of Ghana Business School and also a consultant and my former lecturer as well. but Prof, let me come to one critical thing, that the real impact of this on the economy.
Yeah.
I hear the IMF MD saying that as soon as we close this debt exchange program, we could get that market confidence back. I spoke to some traders in the banks.
Well, I think we may have to get it right. I mean, the debt exchange program at the domestic front or the debt exchange program.
Okay, I need to get that clarity.
The foreign debt exchange program that we're going to have. But then...
But also another quick one as well. I spoke to some traders in some of the commercial banks. And I mean, what I got from them was that we trying to close the page on this domestic debt exchange program and the likelihood of us getting a board approval in end of March or April is impacting on the Ghana cedi. And I'm trying to be that independent person here, but it appears that yes, we are hurting people and a lot of us are being affected, but the broader economy, we might be benefiting from this whole restructuring thing that is going on.
Well, as we speak now, it's a process. And the investors' expectations cannot be taken for granted.
Yeah.
At the same time, the demand for the dollar for economic activities cannot also be taken for granted. Whatever the case may be, after going through this restructuring, it is anticipated that interest structures in the economy will come down. Because at the point where government bonds, right, are selling for 10%, no bank will take your money for 15% and go and invest it at 10%.
Some of them accuse the banks.
Obviously, we're going to have that kind of, interest rate structures coming down completely. But then another thing also we need to know is that over the past few years, most of the banks have swelled up, their asset in government bonds. Yeah. In fact, I just did an exercise with my, banking and finance student, teaching them bank management. Yeah. So I asked them to pick all the banks, individually as a group, and then look at asset concentration. And most of the banks have more of their assets in government instrument. And so
some would say cheap money.
So of course, but I call it lazy banking more or less. Because you're not doing any activity, collecting and then just putting it in government instrument. So the retailing aspect of banking has been missing all this, for some time now. That is why interest rate was going up. So what is going to happen is that the banking sector's interest income is going to go down. And most of the banks, because they have been relying on government, instrument, they have lost, touch of the retail banking, which is supposed to bring them charges, fees, and other.
Even lending to the real sector,
exactly, has
industries,
also been
and all
a problem.
the rest.
So effectively, there's going to be a big hit over there, for which at the end of the day, interest income going down, compromising on non-interest income, means that, okay, fine, banks may not be able to recruit anymore, for some time. So effectively, the dynamics are going to change a bit. But over time, when interest rate structures comes down, you realize that the bank will start focusing on, the retailing, which they will start giving loans to.
But some will say that you don't want to blame the banks badly because with a very high NPLs, a lot of structures that are not in place that are aiding, inflation is gyrating and all the rest. Obviously, a bank will want to do lazy banking in code by just buying government bonds.
Well,
because it's so risk.
I understand. The exposures are
George Yafi and co.
Yeah, it makes sense to look at it that way. But like I said, when the government instrument tends to present something good, you see, government has been business over the years without the private sector. So effectively, when the structures change, the banks will have no choice. They'll start directing.
Let me quickly bring in as you wrap up. And Dr. Danasado, in 2 minutes, for you, again, being in this finance, pensions, accounting space and all the rest, are you optimistic about the future or very measured or worried?
No, we are human beings. We are resilient. We are supposed to solve problems. So I believe that, yes, there's a lot more we can do to survive. I have not given up hope. But before I conclude, I disagree with the lazy banking comment. We have a structural problem. The structural problem being that instead of developing the capital market where people can channel resources to capital market to do the capital project. Everybody is giving money to government. The government must sit up and say, look, here is capital market. Let's say motorway, Accra Tema motorway. Let it be privately done. Mobilize resources. Channel pension funds through that. And structure it that people can enter and exit anytime they want. That as we use the motorway, we pay the tolls, then we are able to recover. The principle I'm sharing is render service to people and ask them to pay. And they will be happy to pay. But when we channel the resources to government and we don't see the project, we'll come back to complain. And when government positions itself to take those resources and we trust government, people will naturally take those monies to those places. Now, coming back to your question, yes, I'm very optimistic. I have hope. I have been in this country for many years because I believe we can work to transform this country. I've not given up yet. But it takes people. It takes engagement. It takes hard work. It takes thinking. I think where we are failing is that we are not thinking deep enough.
Thank you, Dr. Daniel Seddoh, for your time. Let me come back to and very quick things as well. I mean, for you, from your extrapolations, the banking sector would indeed take a hit, but things will pick up going forward.
Oh, yeah, definitely. I mean, we're going to see things picking up. If, like I mentioned earlier, it all boils down to, government expenditure lines. If government...
But going into an election year, and we have a fund program as well.
But remember, we're going into this coming with an IMF program.
That would be real tough for government.
Oh, yes. I mean, it has happened before.
From a culture where everything goes loose an election year.
Government had to lose elections. So, I mean, it won't be surprising for government to be boxed, in terms of its spending. At the end of the day, it's part of the economic build-up.
The governor of the Bank of Ghana is quite confident that we could get a board approval for disbursement to come by Q1. Some are saying maybe April and all the rest. I look at the preconditions. Some of them are quite tough. Do you think we can meet this first quarter?
I don't foresee that happening in the first quarter. But then probably we may give ourselves, second to third quarter.
That would not be good for our reserves, our city.
Yeah.
Because some are saying that the stability we are seeing now is because some people are optimistic that we're closing the DDE, we are going to get a fund program. Yeah. Second quarter is not good, Prof.
Yeah, but that's what the situation presents itself to us.
What should the government, what should government be doing to help revive the confidence in the financial space? Because some are saying that it's at its lowest, some will say.
Yeah, it has to do with communication and assurance. And as part of the negotiations with the various financial institutions, government should have added, the possible assurance, even though we knew very well that IMF will be there to police government spending. Now, the commitment from the government should be rehashed in the entire engagement. Very, very important.
But how would government give an assurance when there's so much uncertainty? I mean, with this debt exchange...
Assurance on government spending. That's what I'm talking about.
In final words, in 30 seconds, Prof?
Well, I believe that is an exercise that the country must go through. And it's a lesson for all of us. It's something that we're going through to make sure that at least the future looks good.
A bitter pill.
Yes.
Let all of us sacrifice, both the bondholders and government itself.
Every economy goes through such dynamics.
PM Express Business Edition engaging Professor Lord Mensah. He is a finance lecturer at the University of Ghana Business School, and also Dr. Daniel Seddoh, and also the other guests. Have a great day. This is PM Express Business Edition.